When we look at a chart, we're first looking for key levels, and that's, I'd say, almost the art of technical analysis, where those key levels can be derived from many different sources. Moving averages would be a very common one as an example. The 200-day moving average, a very widely followed threshold for securities. And I don't know why that ended up being the widely followed parameter, but it is. So we want to know where it is when we're trading something. So we're always looking for these key levels, and the key levels can inform us as to the risk-reward profile of that chart, because they will tell us where there's potential buying pressure and potential selling pressure, because either it's been there in the past, just previous peaks and troughs, or because the technical indicators would suggest it. Maybe, we can get much more complicated about it, but I think keeping it simple is usually the best way to go in identifying these key levels.
In today's internet economy, a global framework is essential for navigating the markets. While headlines differ in Tokyo, London, and New York, the data tells a unified story through one language, the charts. Understand these signals is key to translating market psychology into actionable intelligence. I'm Flávio Lemos, your host today on Traders of the World podcast. We decode this global data-driven conversation. Hello and welcome back to Traders of the World. I'm your host. All right. Before we dive in, the ritual sacrifice to the YouTube algorithm. If this chat depicts any value into your knowledge, smash that like button and subscribe. It keeps the lights on and my caffeine levels adequate. For such a special occasion, I'm not alone. As always, I am thrilled to be joined by fantastic co-hosts. Gilberto Coelho is a prominent figure in Brazil financial market, a certified tech analyst at XP, one of Brazil's largest brokerage firms. He is the creator of an indicator called GBAC Sossegado, Relax GBA, a tool adopted by multiple trading platforms to help investors identify market trends. Known for his accessible and practical approach to tech analysis, GBA actively shares his market insights through YouTube shows, live trading sessions, and daily morning calls, positioning himself as a key voice in financial education in Brazil. Hello, Gilberto. Nice to have you here.
Well, a big pleasure to be here. Thanks for the invitations. Let's together discover the technical analysis. Is great experience for me. Thanks.
Oh, great, Gilberto. Today, we are joined by one of the sharpest and most respected minds in tech analysis, Katie Stockton. She is the founder of the influential research firm Fairlead Strategies, which she launched after a 20-year career on Wall Street at firms like Morgan Stanley and BTIG. Katie holds the incredible distinction of being the youngest female to ever earn the Chartered Market Technician designation, which she attained back in 2001. She has played a major role in the technical community, serving as a vice-president of the CMT Association. She now applies her methodology as the portfolio manager for the Fairlead Tactical Sector ETF, the TACK ETF, a fund designed to navigate changing market conditions using sector rotation and asset allocation. Beyond her research, Katie mentors young women, guest lectures at universities, and is a face many of you will recognize from her famously calm, clear analysis on CNBC. She is here to help us decode the charts and the markets. A warm welcome to the chart whisperer herself, Katie Stockton. I mean, with a name that literally has stock in it, she was clearly destined to this. Huh? Katie, it's a huge pleasure to have you on the show.
I'm so glad to be with you, Flavio, and you too, Jiba. It's a pleasure. And I know we're rounding out a pretty interesting week, too.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Giba, first, the guest.
Let's go. Okay, I've heard your path into technical analysis wasn't exactly planned. Looking back, do you think the chart chose you, or were you just destined to draw lines and Fibonacci spirals on everything, even restaurant networks?
You know, it's funny, Jiba. I do feel like I stumbled into the discipline. I didn't know what technical analysis was when I went to college, and I was exposed to it there. And I think it resonated with me because it's so visual. And also, as a more mathematically minded person, that also suited me very well. I realized that price is really the most important takeaway. As much as I was learning all of the Finance 101 curriculum, I found that it made a lot of sense to have these price trends on your side, irrespective of what kind of security we're talking about. So when I learned about it, it was actually a graduate level course that I audited. And I discovered that course only because I had an internship that exposed me to some technical analysis research. It was at a wealth manager. This was in Virginia. And on their desk, they had some point and figure charts, you know, the X's and O's. And so I said, what on earth is that, effectively? And ended up educating myself through the university and then through also this internship, which turned into a part-time job. So by the time I graduated college, I was very much on the path of technical analysis without having really chosen it, I'd say, intentionally, but very happy to be there and happy to have an expertise because, as you know, in a career, especially early stages, that is sometimes hard to develop. So it was great to come to sort of the market in a way with this skill set.
Thank you.
Your approach is like a Michelin star recipe. Your bear market defense presentation lists your four most valuable concepts: support and resistance, technical indicators, relative strength, and market intervals. How do you balance those four flavors in your daily process?
Yeah, those are the most important takeaways for us for securities. And I don't know why that ended up being the widely followed parameter, but it is. So we want to know where it is when we're trading something. So we're always looking for these key levels, and the key levels can inform us as to the risk reward profile of that chart, because they will tell us where there's potential buying pressure and potential selling pressure, because either it's been there in the past, just previous peaks and troughs, or because the technical indicators would suggest it. Maybe, you know, we can get much more complicated about it, but I think keeping it simple is usually the best way to go in identifying these key levels. Trend lines, you know, just flat sort of support levels that have been tested previously. Those are all very added value because they can also help us identify key catalysts. And for us, technical catalysts are often breakouts and breakdowns. So a breakout would be above a key resistance level, breakdown below key support. So we're always looking for those on the charts, and that's one of the most important things. That's the harder thing to make more quantitative or rules-based, but I think it's the best visual takeaway that we can arrive at. And then, of course, we're using all the technical indicators, and these indicators we use to help us understand not just what the prevailing trend is over various time horizons, but whether that trend is coming to an end. So those can be invaluable. And they're often binary, just mathematical takeaways where you say, okay, is it a buy signal? Is it a sell signal? Is it positive, negative? So those are key as well for us. And they really suit the way we think about things, and like to take some of those emotional biases out of our decision making. And then finally, the market internal measures and relative performance are also key. Relative performance will be, you know, looking at one security relative to another, often looking at maybe a sector in the US relative to the S&P 500. That would be a common relative strength analysis that we do. And then also the market internals, which are more top down. And they'll tell us, okay, well, was there heavy volume on a move? Was there good breadth, meaning good participation? what is the market sentiment, the status of the market sentiment right now, and also where is the leadership coming from. All of those inputs taken together, especially when they're at extremes, can be very informational.
We'll see in a moment these charts. Okay, Gilba, show her.
So, Katie, I saw you use beside price patterns, moving average, MACDs, like we saw in Brazil, stochastic, RSI, and so on. Does one indicator typically lead, or do you need them all to align before you get a clear signal? If you have a chart to example for us, will be great.
I would love to share my screen if I can figure this out, so I can show you exactly the types of templates we use. And in fact, I can share my entire screen. Let's just do that, because I'll show you almost my Launchpad setup. Can you see the screen now?
Yes, please.
Okay, so this is almost our command central is how I call it. It's my terminal window with all the charts that we go and evaluate. And when I load a security, it goes to all of the different windows and we'll load it across multiple time frames. So this is our ETF, which I know we're going to talk about later. So here we have 2 daily charts, daily bars. These are weekly bars. This is a monthly bar chart. And then this is a relative strength line, that ratio that we mentioned. And so with all of these things taken together, we have indicators that will help us with information. You can see, obviously, the moving averages point higher. That's an uptrend. You see the stochastics. That's the stochastic oscillator. You see also the cloud model. This is a shaded area of potential support. You see these numbers floating above the price bars and sometimes below. Those are called the DeMark indicators. It's a third-party provider of these trend exhaustion tools. And then also we have here the MACD, as mentioned, Jiba. This is a great way to discern whether momentum is positive or deteriorating or negative or improving. So it has almost 4 different takeaways in terms of stages of momentum. And these combinations of moving averages can be really very powerful as well. So it's all of this all at once. So the multiple time frames, the multiple indicators, and that kind of view that we use that will make its way into our research. I have here also, we had some slides that we prepped for this. And you'll see that, to make it a little bit of a cleaner view for you, this is the S&P 500 on a monthly bar chart. So very long-term view going back more than 10 years. You can see those same types of inputs, right? So for us, we have the stochastics, we have the MACD and a histogram with it. We have the DeMark indicators here, those numbers. We have just the key support resistance levels perhaps that we're watching. And then this cloud model, also known as Ichimoku, and that's a good gauge of the prevailing long-term trend, which you can see has been a bit choppy in here and resumes higher with a forward-looking element. So it's kind of reflecting the previous action, but also preserves the secular uptrend in its takeaway, just now pointing higher. So this is how we look at the world. We have ways to make it more quantitative too, but this is generally our process, is scrolling through a lot of charts that have very much this kind of template to them.
Perfect.
Okay, keep the charts. You juggle monthly, weekly, and daily charts like a Cirque du Soleil act. I saw one of your presentations showing a monthly S&P 500 chart with negative long-term momentum alongside a weekly one that was newly overbought. When those time frames disagree, who wins the argument? I mean, when a strong trend meets an oversold oscillator, which side do you usually bet on? The macro monthly stage or the more impulsive weekly sign? You can show your charts, please.
Yeah, I'll share it again. So it really depends who you're talking to, because honestly, the daily chart may not be at all of concern for a longer term investor. In fact, we sometimes discourage investors from using the daily chart because that weekly chart will eliminate all the noise that can be appearing on the daily. So a monthly bar chart we think is suitable for a long-term investor. And we would encourage them to just keep their eyes on that, because that will keep it simple for them. And you won't have to ask the question you just asked, which is which time frame do you focus on? You just focus on your long-term time frame. So I think that's a great way to go about it if you can resist. But as a technical analyst, of course, I can't resist. And, we like to zoom in for market timing purposes, and then also to find more opportunity, right? So we're always looking for ways to manage risk, for market timing inputs, and for opportunities by looking at the short to intermediate term charts, which you can see here. This is our weekly bar chart. It has the same indicators for the most part that we saw on the monthly chart. And it's all of these indicators taken together that give us our takeaway. And we find it very helpful to have this time frame on our side, because boy, when you see corrective phases unfold, they can be pretty severe over, maybe the course of 3 months or even longer. So we want to make sure that we have these intermediate term trends, which is the takeaway we feel from the weekly charts, on our side. And then we will further drill in. And I actually don't know if we have the daily chart in here. Here it is. So the daily chart will have some of those same tools. And you can see how different it looks, right? It's a lot noisier in this daily MAC or daily stochastics and daily MACD. So we're going to perhaps give a less weight to those indicators. But at times they can be also very informational, especially as it pertains to that market timing and risk management element. As an example, right now, this is as of today, we saw the S&P 500 come down to its rising 50-day moving average. That's good information for everyone to have, we feel, even if they're longer term investors. They want to know if the top-down picture is changing a little bit and you're starting to see a loss of momentum, that might warrant some reduction in exposure. So we can use the daily chart from a top-down perspective to help us inform our positioning, even if we're long-term investors.
This brings up the eternal debate, trend versus mean reversion. Your toolbox includes classic trend photos like moving average and the Ishimoku clouds, but also overbought and oversold tools like the stochastics and the market indicators. We have interviewed the mark. The mark is
good. Okay. I wasn't sure how familiar.
No, we know him. He's a great guy. When a chart is in a beautiful uptrend above the cloud, but suddenly flashes at the mark 13, and I just saw one in the monthly here, which signal do you trust? How do you manage this type of conflict?
It's so helpful to know when that happens. I know it's a conflict, and yet it's a good one. It's a welcome bit of information that these indicators provide. You see the DeMark indicators, these 13s, as you know, are counter trend indications. This is on the monthly chart, so these will have sort of longer term implications, and they're not perfect, but they do often designate inflection points. And you saw it here ahead of the corrective phase earlier this year. You saw a big one ahead of the 2022 bear cycle. You saw one ahead of the kind of choppiness in 2018. This one was stopped out. So not perfect, but definitely a suggestion from the market that perhaps it's overextended. And then if you have that, you're probably going to, I'd say, listen to the momentum even more closely. The momentum gauge is shorter term. So if you have these signals, which we also happen to have on the weekly bar chart, as you can see, we're going to be more sensitive to something like this, which is when the indicators start to deteriorate over the same time frame. Again, these can be high frequency, so not terribly long in their implications in the duration, and yet enough for some investors to feel like, okay, well, as an example, we've had this great thematic run up in AI stocks. Well, the steep uptrend, now that we have the signs of exhaustion, if we were to see any kind of downtick, we're going to be maybe more respectful of that. So it's not a contrasting indication as much as it is puts us on guard, is the way I'd put it.
Okay. All right, Katie, we have reached as our signature part of our show, but I want to frame it correctly based on your great feedback. I know you are a strategist and a researcher, not a day trader. So instead of a best and worst trade you made, let's talk about the best and worst call. Could you walk us through a recent good idea from your research, one you are really proud of where your analysis was just spot on? And on the flip side, about a recent bad idea, the one that was humbling, looking right, but the market just refused to cooperate, and what was the most valuable lesson you took away from it? We'd love to see.
Yeah, of course. So what I'll say is that, if we think about that from a top-down perspective, because we're always giving episodic views of the S&P 500 to that end to help people manage risk and discover opportunities. So in a way that this year, if I can refer to one that was both good and then became bad, that I think would be a good sort of case study in this event. And then I'll talk about a couple of stocks as well. But for the S&P 500, when it came down to this low, we had what we would call extremes in those market internal measures. So those are things like the sentiment and the breadth data. Let me see if I have a good example here. Yes, here's one, the fear and greed index. When we saw that low unfolding, these market internal measures got very extreme, and it was a collection of them. And it's when we have that collection of indications that are saying, okay, we're flashing green here, we're flashing green, that's when we're paying attention. So what was great about that as a good market call was that we helped identify the April low. So the April low in the S&P 500 this year, you saw it was a very sharp and kind of climactic low, almost like a classic V bottom. So we helped identify that low in real time, given our market internal measures, and then also with help from the DeMark indicators. I'm not sure if this chart will show it, but so we don't have DeMark on this one, but right here at this April low, there was a pretty timely DeMark buy signal. So that was great. However, after running up for a few weeks, we started doubting in May whether we could see new highs registered. And of course, you can see that new highs were definitely registered, right? So right around here, we said, okay, this is getting a little bit worrisome. We had some downturns in our short-term indicators. And what we didn't know at the time, and pretty quickly learned thereafter, is that there's a lot of noise that ensued. So this first downturn here and here just gave way to this really unusual environment that we've all had to navigate together this year, where you see pullbacks of only a few days at a time, not even enough to allow for an oversold reading. So we had an oversold reading at that April low. We haven't had one since, which is really remarkable. I've certainly never seen that in my recent memory. So we got sort of whipped by the market right in here. And yet we jumped back on as soon as we saw this happening. The reason we got back on board and kind of walked away from a sell in May type of mentality was because the S&P did break out. And so above anything else, we believe that breakouts are some of the most actionable takeaways on the chart. So in this case, it was simply a breakout from a consolidation phase here with a gap that had that kind of breakaway gap feel. But then also the resistance was cleared. So we were able with this this breakout to discern a price objective using a measured move. The measured move, as you probably know, is assuming the trajectory of the trend will maintain itself. This is a long-term trend. So it allowed for a measured move of the S&P of about 68.80. And this is not a prediction at a certain point in time. It's just saying, okay, well, if the uptrend keeps this way, then it should be able to achieve that with a 100% replication of it. And sure enough, we just reached that level. And this is where we're starting to see a pullback that has a bit more oomph to it than the previous pullbacks that we've seen since that April low. So these are the kinds of calls that we sometimes will find humbling, like in May of this year. but then also can really help us stay with the market when it's warranting it. What we did in a way to navigate through this noise was adapted to using this 20-day, which is in blue, and you see how it just continued to point higher. That 20-day was a great way to smooth it out. So as simple as it is, I think it's a great way to understand if the prevailing trend is still in force, right? So we just adapted to a different market environment, and we're glad we did that because we were able to capture the most of the uptrend, if not those few weeks in May that we feel like we kind of missed out on. So that's our constant challenge. But what we're trying to do in our research is not only help people, find these opportunities and leverage the trends, but also to manage risk. So we're really very attuned to risk management and different stop losses, that type of thing. What we do, in addition to our top-down views, which are, I think, so important even on the individual stock level, we have ideas that we put into a Substack newsletter, and Substack's just a vehicle for that, and we call it the Fairlead Idea Generator, and it's we'll find things that are usually outside of the S&P 500 for this. Here we have this Tencent Holdings. This was a Chinese equity, or it's an ADR listed here. And you can see we highlighted, this was in July, mid-July, a triangle breakout. We felt like triangles are among the most actionable breakout there is. So triangles reflect that kind of compression and volatility, and then it tends to kind of surge from that. So that was right here. So that was a great example of a very actionable breakout that we were able to capture on the individual stock level. There, of course, are times at which that it just doesn't work that way, right? So we look for different setups. This is Melli or Mercado Libre. Forgive my accent.
No problem. It's an Argentinian company.
Yeah. So it's been stair-stepping higher long-term. What a great long-term uptrend, right? So we're in part just trying to take advantage of that with this momentum uptick that we had in our indicators. Well, sure enough, that one did not work at all. So it does happen. The way this is kind of where we were at that moment, and it just failed on us. Thankfully, it's still in an uptrend. So for those that are interested in Melli at this time, I would say at least the implications of the breakdown are probably past at this point. But the way we manage through sort of our positioning and our thinking is by always having a level at which we are kind of uncomfortable with a position or a recommendation. In this case, we're using the 50-day moving average. And what we tell our readers typically is that if you can establish a stop loss threshold and not necessarily put like an order at that level, right? Like a stop order, but rather watch it and see if it can hold, because these levels are cushions, they're not precise points. But if you see a pretty decisive move, whether it's in price or time, below this threshold for a long idea, then that would be a reason to kick it out, right? Or to reduce it, however you manage risk, right? So we always have these defined levels with which we can manage risk. And that's how we would encourage people to use the charts to their benefit, to not only find opportunities, but then also to manage risk and understand, what they're willing to lose on it.
I'm curious because you just showed the fear and greed index hitting those bearish extremes. But market seems to have worse mood swings than teenagers. Use these market internals like sentiment and breadth to gauge these. How do you use those sentiment tools to tell the difference between a real, durable regime change and just another emotional overreaction?
Yeah, and you're right. I think it is. There's a lot of those overreactions, right? And you do feel like the pendulum is always swinging. We don't believe in, the necessary like mean reversion, right? We don't see the 200-day moving average, to kind of address your previous question, as a magnet for price. Like, it's not a bearish thing necessarily to see a security stretched well above its 200-day. All that means is that it's had good momentum. But it can be bearish if you have a very steep move one way or the other, and then you, associated with that steep move, get extremes in the market internals. So we have ways to assign measurements like this fear and greed to the psychology behind the market. And
does it have the data for today? Is it input?
I believe it's either as of today or yesterday. So yes, we're
okay,
very
so it's very close.
Yeah, so we're already in oversold territory. It's with the 10-day moving average. You can see we're not quite there. We like to smooth it out a little bit. But in reality, you know, you can spend a bit of time at these oversold thresholds and vice versa. More often staying oversold longer than you stay overbought on this metric in particular. So when you start to watch these internals and indicators, you get to know their nuances. And that's why I tell people you're well served if you're studying technical analysis or trying to learn it as an investor, to use the same tools, to go back to the same tools time and time again, and to not make it too complicated.
Talk about leadership rotation. Use relative rotation graphs of our friend Julius to track this. When sectors are swapping leadership like musical chairs, how do you use RRGs and relative strength to spot the next real leader versus just a short-term diva move?
Yeah, I love these RRGs, or relative rotation graphs, from Julius. They, I think, are great ways to I guess, visualize the rotations that we know are in the market. And this is the maybe most obvious one, being the sectors of the S&P 500. We know there's cyclicality there, and you can see it here. This is, you assume this moves in a clockwise fashion, and these are the trailing histories of each of the sectors relative to the S&P 500, which lives right here, the crosshairs, and everything's normalized. So you can see where healthcare is, not only relative to the S&P, excuse me, but also to energy and the others, and make sort of a fair apples to apples comparison of their relative performance. So if you assume the clockwise rotation, well, this is how we find opportunity here. We would generally want to see something pointing up and to the right. We like to see emerging situations like this consumer staples here, a brand new uptick, or rightward tick, I should say. We wouldn't like to see something like this, right, where tech seems to have fallen out of favor. So it can be almost a top-down takeaway that we can receive from the sector RRG. But we also like to use them for bottom-up stock analysis, right? Looking at various stocks within a sector relative to the sector, perhaps, or stocks within a portfolio relative to the portfolio's benchmark. All of that can be very, I think, helpful as a data visualization tool. And, you know, we think that hopefully everybody can access the RRG somehow, because I think as a portfolio checkup, it's such a great tool to have at your disposal.
You are not just an analyst, you are a portfolio manager. The strategy is model-driven, but has a discretionary overlay. The tech model is fascinating. It's allocated between risk-on sectors, ETFs, and risk-off assets like treasuries and gold. Can you walk a bit us through that? How do you balance the systematic model with your own sharp whispered intuition when managing the fund? And what specific signs from your indicator toolbox tell the model to play defense or attack?
Yeah, so for TACK, TACK is a ticker, and it's called the Fairlead Strategies Tactical Sector ETF. And we use our methodology, really just what you saw, in fact, in the charts, is effectively what's made its way into a rules-based model behind TACK, which is investing primarily in the sector spider ETFs. So think of TACK as a fund of funds. So what we've done is use long-term data. We're using monthly closing data, and therein making sure that it's eliminating a whole lot of noise, really just honoring the long-term trends, long-term momentum, and long-term relative performance as our primary inputs, often incorporating risk metrics, things that might suggest whether it's too overextended or otherwise. So we're trying to, at its core, put TACK as an equal weight sector approach. This is where TACK's model stands right now. So forgive that it's just the tickers. But here we have 75% of the portfolio is in these sector ETFs. And then the other 25% is in alternative asset classes, also represented by ETFs. So we have a 75% equity exposure, and then we have exposure to short-term treasuries, which is this one, long-term treasuries, and gold. And we do that to limit drawdown. So when the equity market is trending lower, we have, from our model, fewer sectors to include in the portfolio. If we don't have our sectors qualifying, we will not include them, but we will replace those sector positions with this combination or something close to it of the alternatives. So it's a very dynamic approach using long-term technical analysis, using what I would call a sophisticated technical model, but one that is aligned with the concepts that we've already discussed today. And the end result is something that serves as a great core to an investor's sort of portfolio, whether it's a retirement fund. I think it's very applicable for a retirement account, or something that is there to counterbalance perhaps a tech-heavy portfolio. You all are probably well aware of the tech concentration here in the US. We have 33% plus exposure in the S&P 500 to technology. So this is a fund that will max out at about 12.5% in its model for technology exposure. So it gives this exposure to sectors that are still trending higher with good momentum on a long-term basis, but might not have good representation perhaps in the rest of a portfolio. That's what we found is a lot of our clients on the research side have too much tech, and they could be well served to have it balanced out by things like utilities here and industrials and other core sectors of the market. I hope I answered your question.
Yes, you did. Does it have any gold? You have, but crypto, no.
No, so I'll show you, and this is actually kind of a cool graphic. This is the dynamic history of TACK since inception. And you can see how the sector positions have changed throughout, and how also see the gold exposure is actually in gold. So you can kind of see how the gold exposure has morphed over time as well. The bluish exposure is actually treasuries. So you can see it got very heavy in the treasury market after during and around the 2022 bear cycle. So it's got the sort of dynamic approach to asset allocation and then also sector investing. And we're able to, provide something that hopefully people don't have to worry too much about. That's one of the goals, is that it will be invested, it will take advantage of uptrends, but also has the capability to manage risk at the same time.
Do you think to include Bitcoin or something like this in it or not?
To include what, I'm sorry?
Bitcoin?
Oh, yeah. For this fund, we wanted to really focus on U.S. equity sectors, and it has often been treated as a U.S. large cap core type of ETF, or some advisors might consider it more hedged equity as exposure. You introduce Bitcoin, that changes everything. So it's not a fund that will hold cryptocurrencies. We are working on other strategies that are a bit more volatile, higher beta. That certainly we're open-minded to Bitcoin as an asset class for those types of portfolios. But for this, which is a conservative, long-term core, it's not really aligned with the objectives.
I know you had to go, so just two more questions. First one, if you could give one piece of advice to the next generation of tech analysts, something that they won't find in any textbooks, what would it be? Bonus points if it fits on a sticky note above the terminal.
I think the advice that I would give is to try to be systematic in how you're approaching technical analysis. If you can find a methodology that suits you, knowing that there really is no one right methodology. It just needs to suit your process, your way of thinking, your time horizon, your risk metrics, things of that nature. But once you have that sort of methodology behind you, to be systematic in how you approach it. It doesn't mean you have to develop a sophisticated trading system, but I think you're well served to have discipline. And it can be as simple as, I will not buy anything that's in a downtrend according to the cloud model. It could be as simple as a rule like that, to keep you on the right side of prevailing trends. So if people can employ it that way, I think that's where the real benefit can be derived over the long term.
Go on, Giba.
The last one or the next?
The last one.
The last one, okay. Katie, this has been a masterclass, incredible. Where can our audience follow your work, learn more about Fairlead Strategies, and find the TACK ETF, please?
Yeah, of course. So, and I'll put up some returns while we're talking versus the benchmark for TACK. The best way to reach us is probably through our website. We have a form folks can fill out just so that we can receive an email, or simply email us at info@fairleadstrategies.com to request a free trial of our research, which has charts just like you've seen. We also have a newsletter that comes out monthly about TACK, the ETF, which is free to anyone. We post that via LinkedIn. So if you follow me on LinkedIn, or if you follow Fairlead Strategies on LinkedIn, you will see the TACK monthly newsletter in your feed. And it's a great way to understand how TACK is positioned, of course, but then also a loose sort of overview of how we feel about the market at that time from a top-down perspective. The website for the fund is fairleadfunds.com, and our firm's website is fairleadstrategies.com. So for anyone who's interested in the research, we have all the information about subscriptions and what we do. We also have links to our media exposure. Things like this wonderful podcast that you have can be found there as well.
Katie, this has been a masterclass in blending art, science, and disciplines. Thank you for making these complex topics so accessible and for sharing your wisdom with us. Thank you very much, Katie.
Thank you so much for the invitation.
Okay, folks, that's all we have for today. Traders of the world, a massive thank you again for Katie Stockton. Giba, thank you as always.
Thank you. It was a pleasure. Nice to meet you. I'm impressed with what I saw here. It's amazing. I'm crazy now. Thank you.
Thank you so much.
You have to get the kids at the school.
I do. Okay.
So, guys.
Take care, everyone. Enjoy the weekend.
Okay. Until next time, stay distant, watch those trends, and don't let the market's mood swings get the best of you. Take care. Bye-bye.